بسم الله الرحمن الرحيم والصلاة والسلام على أشرف المرسلين سيدنا محمد وعلى آله وصحبه أجمعين أما بعد. Dear my students, today we are going to discuss chapter 3. This chapter, it's one of most important chapter in our course. In this course, we are going to discuss financial ratios and the financial performance. In this chapter, by the end of this chapter, you must be able to understand who uses financial ratios and why. Number two, how could you use financial ratio to analyze a firm liquidity and activity. Number three, discuss the relationship between debt and financial leverage and the ratio used to analyze a firm debt. Number four, using ratios to analyze a firm profitability and its market value. And finally, how could we edit a summary of financial ratio and the use of do-bond system of analysis to perform a complete ratio analysis. Before we studying by the financial ratio, there is a need to explain from where we could get the data and information which are required for our analysis. Actually, for any business organization, particularly for those listed in the financial market, actually we have four key financial statements. Those four key financial statements, actually they could provide or can be considered the main source of data and information that could be used in analyzing our data set. The first key financial statement is income statement. Income statements provides a financial summary of a company operating result during a specified period of time. Such a type of income statement could be prepared quarterly or could be prepared monthly or could be prepared annually. Actually, the most famous type of this financial statement in income statement is to prepare this type of financial statement annually. Annually, yani if you give a look for the income statement, you will have a financial summary of a company operating result during the specified period. As you see, this is an example of the standard form of our income statement. As you see, in 2012, for instance, we started by sales revenue, less subtract cost of goods sold, you will have gross profits. Then we are going to exclude our operating expenses such as selling expense, general and administrative expenses, lease expense, and depreciation expense. The sum of those operating expenses is total operating expense will be subtracted from our gross profit for getting what we call operating profits. Sometimes it's called EPIT. EPIT, it's earning before interest and tax. But either you describe it as operating profits or you are describing it as earning before interest and taxes. Then we are going to exclude interest expenses for determining what we call net profits before taxes. Then we exclude the taxes for getting what we call net profit after taxes or sometimes we refer to it as a net income. يبقى net profit after taxes, or what we refer to it as a net income. In this situation, we are going to use this net income or net profit after taxes, number one, for paying what we call preferred stock dividends, because it's a must. And if you have a preferred stocks, you must pay for them dividends. The remaining part of your net income will be considered as earnings available for common stockholders. This earnings available for common stockholders, you could use it for paying dividends for stockholders, or you could retain it in a shape of retained earnings. This earnings available for common stockholders, we are going to use it for determining EPS, earning per share, where the earning per share could be determined through earnings available for common stockholders divided by number of shares of common stock outstanding. يعني example, in 2012 our earnings available for common stockholders is in amount of 221,000. Then we are going to divide it by number of shares of common stockholder outstanding, which in this exercise it is in amount of 67,262. But then we are able to determine what we call EPS, earnings per share. Also, using earning available for common stockholders could be used for determining dividend per share. Dividend per share, it's equal to earnings available for common stockholders, and we divided by dividends available for those stockholders divided by a number of shares outstanding. But again, you must be aware of the basic difference between EPS and DPS. EPS, earning per share, which is equal to earnings available for common stockholders divided by the number of shares of common stocks. Dividend per share, it's referred to dividends paid to common stockholders divided by the number of shares of common stock outstanding. This is the first source of getting data and information which is required for our financial analysis. Another type of statement which is very important, it's called balance sheet statement. Balance sheet statement, actually it presents a summary of a firm financial position at a given point in time. This is why we always saying this is a balance sheet of a specific firm on 31st of December, a specific date. Yani we are trying to reflect the firm financial position at a given point in time. This type of statement is divided into two parts, two sides, the right hand side and the left hand side. The right hand side, it's a reflection of the firm's asset, reflect what the firm owns, and on the left hand side, actually it's a reflection of how this firm is going to finance its activities. And this could be done either by debt, and we're trying to determine what this firm owes, and determining equity, what was provided by owners. This is actually the main components of the financial statement. Here, let us take an example. This is an example of a specific firm financial statement and the balance sheet. As you see, we have the right hand side, which is the reflection of investment decision, particularly the fixed part of this asset. The assets part consists of two components. We have current assets and we have fixed asset. In this example, current asset consists of cash, marketable securities, accounts receivable, inventory. Some of them is the total current assets. And the second component is the fixed asset, which consists of land and building, machinery and equipment, furniture and fixture, vehicles, or any other financial leases. Some of those assets will be considered as the gross fixed asset. We subtract the accumulated depreciation of it to determine what we call net fixed asset, the sum of total current assets plus net fixed asset. This will give you a total assets. According to accounting standards, your total assets, according to the balance sheet identity, must equal the total sum of your liability and owner equity, and this is what it appears in the side of liability and the stockholder equity. The sum of your liability and the stockholder equity, which is 3,597,000. This is actually equal to the asset of this firm. As you see, this right hand side of your balance sheet, it starts by liabilities, and liabilities can be divided into current and long-term liability. As you see, our current liabilities are accounts payable, notes payable, accruals. Long-term debt plus your total current liability, we have what we call total liabilities. The second component of the bar is the equity, and this equity, it consists of preferred stocks, common stocks, paid in capital, retained earning. The sum of total stockholders' equity plus your total liability, it will give you what we call total liability and stockholder equity. Another important statement that you must aware, it's called statement of retained earnings, and this is actually reflect or reconcile the net income earned during a given year and any cash dividends paid with the change in retained earnings between the start and the end of that year. How it is, give a look. If I would like to edit the retained earning statement, first we started by the retained earning balance at the beginning of 1st of January, a specific year. Then we are going to add net profits after taxes of year 2012, for example, and then we are going to subtract any type of cash dividends which we are going to pay during, for example, 2012. Yani in our case, if there is dividends for preferred stocks, if there is dividends for common stocks, those types of dividends must be considered as cash dividends and must be subtracted from sum of retained earnings balance and the net profit after taxes. So the result, it will be retained earning balance. In this case, in our example, our retained earning balance 1,012 plus our net profit after taxes 231. Then we are going to subtract dividends for preferred stocks, dividends for common stocks. So we are going to subtract 10 and 98. So the remaining part, which is the retaining earning balance at December 31, 2012, it's about 1,135. But as you see, this is actually one of the most important statements which are required for our financial analysis. If you have a data of such a type of financial analysis, what you are going to do with them? Actually, analyzing of data and the information existed in those balance sheet statements, income statements, retained earnings statements, play a very important role in analyzing and monitoring the firm performance. Yani if I would like to monitor the firm performance, this will be done by financial analysis using financial ratio. Also, if you are current shareholders or if you are a prospective shareholders and you are interested to know what is the current and what is the future value of risk and return existed in this firm, analysis of such data and information is very helpful in supporting this matter and to understand what is the impact of risk, what is the impact of the return on the share price. Also, number 3, if you are creditors, actually you are interested in the short-term liquidity of the company and you would like to ensure whether this firm is able to make its interest and its principal. Also, if you are a manager, actually you are concerned with all aspects of the financial situation and you are trying to produce a financial ratio that will be considered favorable either by owners and creditors. But from this perspective, I think financial analysis play very important roles in supporting many type of decision related to financial organization. How we could conduct the financial analysis of a specific firm. Yani if I have a firm and I would like to analyze its performance, I would like to analyze its expected return, I would like to analyze its risk, I would like to analyze its debt, I would like to analyze whether this firm will be able to pay its obligations or not. All of these things could be done by financial analysis. To conduct the financial analysis, we have different types of this financial analysis. The first one, it's called cross-sectional analysis. يعني إيه كلمة cross-sectional analysis? Cross-sectional analysis, this is the comparison of different firm financial ratios at the same point in time. يبقى cross-sectional analysis, we are going to compare of different firms' financial ratio at the same point in time. And this includes comparing the firm ratios to those of other firms in its industry or to industry average. For example, if I have company X and I would like to know what is the performance of company X. Either I compare the financial ratio of company X on 31st of December 2012 with the same ratio in another firm. This could be, or we compare this ratio with what we call industry average, and this is a certain type of cross-sectional analysis. We have a very important concept. It's called benchmarking. What is the meaning of benchmarking? And this benchmarking can be also considered as a certain type of cross-sectional in which the firm ratios values will be compared to those of a key competitors or a group of competitors that it wish to emulate. This is called benchmark. Yani, for instance, you are working in the cement industry and you would like to benchmark your performance. You are seeking to know what your competitors are doing. Then you take one ratio or more of your firm in a specific date, and you are going to compare this ratio with your competitors to see how is your situation, and this is called benchmarking, which can be considered as a certain type of a cross-sectional analysis. Example for this. Imagine this is an example of a cross-sectional analysis. For example, we calculated a specific ratio. It's called inventory turnover. Inventory turnover. I would like to compare this ratio with either you are going to compare it with other firm working in the same area at a specific time, or you are going to compare it with what we call an industry average. For instance, in this example, this firm, its inventory turnover, it's 14.8, which is more higher than the industry average, which is 9.7. This means that we have high efficiency in managing our inventory. As you see, you could calculate different types of ratio, and we are going, inshallah, in this chapter to calculate each one of them, and then you are able either you comparing this ratio at a specific date with other ratio of other competitors, or you could compare this ratio with the industry average. For example, we have, for example, Day Corporation and the Hewitt-Packard Corporation. This is very famous companies working in computers and the computer accessories. Then we are going to calculate different types of ratio. We're going to calculate current ratio, quick ratio, inventory turnover, and so on at a specific date. And then we are going to compare this ratio with the ratio of other competitors. And based on this comparison, we could determine how is the financial performance of my firm against the other. Another type of financial analysis, it's called time series analysis. Time series analysis, it's an evaluation of the firm financial performance over time. Yani we are not based our evaluation at a specific point in time, but actually we are going to take many years. It's called series, time series. We are using penny data. Penny data, yani you are going to depend on how is the performance of your firm based on a specific ratio over a number of years. Through such a comparison, by comparing your current performance with your past performance, you could determine and assess the firm progress. Also, by assessing such a type of progress, you will be able to determine what is the shape of a trend in this progress. However, whether we have positive trend or whether we have negative trend. Of course, based on time series analysis, which we could refer to it using Binet data, actually this approach compared to ratio analysis based on a cross section, of course, it will give more informative data and information about the financial performance of this firm. Some companies, they are using hybrid analysis. Hybrid analysis, yani first, they depend on a cross-sectional analysis, and then they combine such a type of analysis with the time series analysis to get more data and information about the financial performance of a specific firm. As you see, we have the firm Bartlett, and we have the industry average, but we don't have it at a specific point of time, but actually we having it in a shape of time series. Yeah, we have the financial performance of Bartlett firm and its industry over a number of years from 2009 to 2012. By comparing the performance of Bartlett company average with its industry over a specific period of time, which is between 2009 to 2012, you will have more knowledge and more data about how is the performance of this firm against its industry average. But as you see, the financial performance could be used in different firms, but there are many cautions, and I started by the cautions to take this in your consideration, because if you would like to generalize the information and the knowledge about this financial performance, you must be careful about this caution, or sometimes we refer to it as disadvantage of financial analysis. Number one, ratios that reveal large deviation from the norm, in most of cases, it's a reflection of there is a possibility of a problem. But you must be careful. Yani when you calculate a ratio and when you compare with the other ratio and you find big gap, big difference, you must be careful about this because maybe you are facing some error or some problem in this. Number two, depending only on a single ratio, this doesn't provide sufficient information in general. Therefore, when you would like to assess the financial performance of a specific firm, you must depend on multiple financial ratios rather than to depend on a single ratio. Also, when you're comparing a ratio with others, you must try to compare it dated at the same point in time during the year. Yani if you are going to compare a specific financial ratio in 2009, you must compare it with the ratios of another firm at the same period of time. Don't mix between different periods, because this will give a wrong indicator about the financial performance. And it doesn't good to compare ratio of a specific firm in 2009 with a ratio of another firm in 2010. But if you are comparing between two different firms, it's preferred if you are using the same point in time, because this gives you more accurate information. Also, when you are going to use financial statements, it is preferable to use audited financial statements. Because sometimes, to ensure high level of disclosure, high level of transparency, your financial statement must be audited by a specific external auditor to be fit for your financial analysis. Also, a result can be distorted by inflation, and you must be careful about a negative impact on inflation on your results. To explain how we could the financial analysis in a specific firm, let us start by an hypothetical example. We have the financial ratios calculated based on the following financial statement. Here, that the financial statement that we explained, Part 8 in 2012 and in 2013, and we are going to explain how we calculate the financial ratio for this firm. Let us start by what different types of ratios that we are going to calculate. Actually, we could classify them into different dimensions or different perspectives. The first dimension is mainly concerned with the liquidity situation of a specific firm, particularly over short term. And if you are interested to assess the liquidity position of a specific firm over a short period of time, you are going to assess this performance using the liquidity ratio. This liquidity ratio, it includes the following. The first one, it's called current ratio. Current ratio equals current assets divided by current liabilities. Current assets, current liabilities are derived from the balance sheet statement of Barclays company. As you see, our current assets, 1,223,000 divided by current liabilities, which is 600,020. By dividing in two sides, our current ratio, it is 1.97. You must be careful that liquidity is important. Of course, it's very important because it's particularly the liquidity over the short term, because it will reflect whether you are able to cover your requirements over a short term. Therefore, you must give attention in managing your short-term asset to ensure that you have enough liquidity over a short term, which is very important for covering your obligations over the short-term range. Another ratio that could be used for assessing the liquidity, we have what we call the quick ratio. What is the quick ratio? Quick ratio, it's equal to a difference between current assets minus inventory divided by current liability. As you see in this ratio, the main difference between current and the quick ratio is that in the quick ratio, we subtract inventory of our current assets. Why we subtracted it? Because in most of cases, this inventory is the less element in the current assets to be converted into cash. You need to have a lot of time to convert this inventory into cash. So if you are interested to assess how is the liquidity position of a specific firm over a short term, it's better that if you exclude the inventory size of your current assets. As you see, by excluding the inventory of the current assets, you will find that the ratio, it is dropped from 1.9 some in this matter to have 1.51. This is actually the real reflection of your liquidity over a short term. Therefore, you will find that many researchers in the area of finance, when they are going to assess the liquidity position of the firm over the short term, they are interested to calculate quick ratio rather than the current ratio. As you see, give a look. We have three companies. We have Dell, we have Home Depot, and we have Lewis. We calculated the current ratio for those, and then we calculated the quick ratio. And this table is showing you that how the quick ratio can be a good indicator of the real liquidity of a specific firm. If you are going to depend only on the current ratio, you are going to have a wrong indicators, because if you are only depend on current ratio, you are going to conclude that all of the three firms, they have the same level of liquidity over the short term, because each one of them in this date, they are achieving 1.3. But actually, this is not true, because when we calculate the quick ratio and when we exclude the inventory from the current assets for each firm, you will find that the quick ratio indicator of Dell Corporation, 1.2, it is heavy dropped in the Home Depot by 0.4, and it is less by Lewis to be 0.2. But as you see, all three firms have current ratio of 1.3. However, the quick ratio for the Home Depot and Lewis are dramatically reduced than their current ratio. Why? Because of the existence of inventory, and the inventory is giving you a wrong indicator about the liquidity of your firm. Therefore, if you would like to have a good picture regarding the liquidity of your firm, you must depend on a quick ratio rather than the current ratio. This is the first part of my lecture, that if you are interested to assess the short-term liquidity of a specific firm, this could be assessed using the liquidity ratio, which include the current ratio and the quick ratio. Another group of analysis, if you are interested to assess what we call the activity ratio. Activity ratio, if you are interested to determine whether you are using the asset in an efficient way or not. And if you are interested to assess the level of efficiency regarding the use of your assets, then you could assess the following ratios, which we refer to it by activity ratios. One of the first important ratio in this matter, it's called inventory turnover. Inventory turnover could be specified by cost of goods sold divided by inventory. Cost of goods sold divided by inventory. Cost of goods sold from the income statement, inventory from the balance sheet. By dividing both of them, you have 7.2. Take in your consideration that one ratio itself is nothing, because you couldn't be in a situation to determine whether this is good or bad. But as I told you, you need to compare it with another firm or with another group of firms at the same point of time, or you would like to compare them with the industry average, or you need to compare them with the time series analysis to determine whether this is good or bad. This inventory turnover, if you are interested to determine it in days, and you are interested to determine after how many days you are able to get rid of your inventory, then you are interested to determine what we call average age of inventory. Average age of inventory, you are interested to determine how many days it is required from this firm to get rid of its inventory. This could be determined by 365 divided by the calculated inventory turnover. In this firm, we calculated previously inventory turnover at a level of 7.2. By divided 365 by 7.2, you will have what we call the average age of inventory, which in this case is 50.7. What is the meaning of 50.7 days? It means that this firm, its average age of inventory is 50.7 days, which means that this firm is able to get rid of its inventory in a period of time equal 50.7 days. Another ratio that could be used for assessing the activity, it's called average collection period. Average collection period. Average collection period equals account receivable divided by average sales per day. By average collection period equals account receivable divided by average sales per day. Account receivable, it's existed in your balance sheet. Annual sales, it's existed in your income statement. To determine the average sales per day, you divide annual sales by a number of days per year, which is 365. By implementing this using our data in the Parklet company, our account receivable is 503,000 divided by 8,422. You have about average collection period equal 59.7 days. Another ratio that could be used for assess the activity, it's called average payment period. Average payment period equals accounts payable divided by the average purchases per day. Account payable existed in the balance sheet. Average purchases must be given in a shape of annual purchases. If you know the annual purchases and then you divide it by 365, which is a number of days per year, then you will be able to determine average purchases per day, and then you could determine average payment period. In our example, accounts payable, it's 382 divided by average purchases. You must have information, for example, in our exercise is telling you that this company, its purchases is about 70% of its cost of goods sold in 2012. So if you have this information, you will be able to determine how much is your annual purchases, divided it by 365, and this means that our average payment period, it is 95.4 days. Another and final ratio that could be used for assessing the activity, for assessing the efficiency of using your resources, we have what we call total asset turnover. Total asset turnover, this equal to sales divided by total assets. يبقى sales divided by total assets. Sales, this is existed in the income statement. Total assets in your balance sheet. By divided it, it's equal to 0.85, and this is our last ratio regarding the assessment of the efficiency and the activity of using the resources of my firm. But again, by the end of this part, you must have in your mind two subsections of ratios. The first subsection is regarding the liquidity of your firm over the short-term range. The second subsection is regarding the activity, the efficiency of using your resource. The third subsection of this lecture is to assess the level of debt existed in your organization, or we could consider it the leverage. If you are interested to assess the level of debt in your organization or the level of leverage, you are going to calculate one of the very famous ratio. It is called debt ratio. Debt ratio can be calculated by total liabilities divided by total assets. Total liabilities divided by total assets, it will give you what we call your debt ratio. As you see in this firm, by dividing total liability by total asset, it is 5.7%. This means that this firm is going to depend on debt by a percentage of 5.7% to cover its investments, and to cover its capital. يعني capital of this firm, it consists of a percentage of 45.7% as debt. The remaining part, which is 1 minus 5.7%, this will represent the equity of this firm. Yani this firm in its capital, it consists of 5.7% as a liability, and the remaining part will be considered the equity in this firm. Another important ratio, it's called times interest earned ratio. Times interest earned ratio could be calculated by determining EBIT, earnings before interest and taxes, divided by interests. If you are interested to determine what are times interest earned ratios, this will be determined by EBIT, earnings before interest and taxes, divided by interests. In our example here, our EBIT, احنا سميناها هناك يا جماعه operating profits. The operating profits, or earnings before interest and taxes, we divide it by the interest. It is 4.5. What is the meaning of 4.5? And this firm, its EBIT, will enable this firm to cover its interests by 4.5 times. By the end of this part, you must be aware of how is the leverage of this firm. And to assess the leverage of your firm, you could determine either debt ratio or times interest payment, times of interest payment, and how many times you are able to pay your interests using your operating profits or earnings before interests and taxes. The fourth subsection, which is very important for every investor and also for the manager, which is called the profitability. If you are interested to assess the profitability of a specific firm. This could be assessed by what we call profitability ratios. How could we determine profitability ratios? The first one, it's called gross profit margin. Gross profit margin is equal to sales minus cost of goods sold divided by sales. Sales minus cost of goods sold, this means gross profit, divided by sales. In our example, you have this data, sales, cost of goods sold, and it says from an income statement, you will find that our gross profit margin is 32.1%. The same, you could determine what we call operating profit margin. Operating profit margin could be determined by operating profits divided by sales. Operating profits divided by sales, operating profits, or sometimes we refer to it by EBIT, earnings before interest and taxes, divided by sales. In our example, it is 13.6%. Also, you could determine net profit margin. Net profit margin, this is equal to net income, or sometimes we refer to it by earnings available for common stockholders divided by sales. By dividing net income by the sales of the firm, you could determine our net profit margin. In this case, it is 7.2%. Another important ratio, it's called ROA, return on assets. And in the return on assets, ROA could be determined by dividing net income by the total assets. You calculate the net income or earnings available for common stockholders, and you divide it by total assets. In our example, our net income is 221,000. You divide it by the total assets. This will give you what we call 6.1%. What does it mean? This ratio is very important because it gives you exactly how much profits you are expected to have if you are investing £1 or $1 in the asset of this firm. For instance, if I'm going to invest $1 in the asset of this firm, I'm expected to have a net profit of 6.1%, 6 cents. For each dollar invested in this firm asset, I'm going to have 6 cents as profits, at a net profit of my investment in this firm. Another important ratio related to the profitability, it's called return on equity, ROE, return on equity, which is net profits or earnings available for common stockholders, and we divide it by a common stock equity, or sometimes it's equity. In some textbooks, they take net income, divided it by the equity of the firm. This will give you what we call a return on equity. In our example, this is net profit. We divide it by the equity of the firm. It will give you 12.6%. As you see, always the percentage of the return on equity is higher than the percentage of the return on assets. Why? Because in the return on equity, we only just divide by equity size, but in the return on assets, we are dividing by the total assets, which is more than the equity. This is why the level of the return on equity must be more than the level of return on assets. What does it mean? It means that if you are going to invest $1 in the equity of this firm, you expected to get net profit of 12.6%. You are going to achieve 12.6 cents for each dollar invested in the equity of this firm. By the end of this section, you must be able to understand how you are able to assess the profitability of a specific firm. If you are interested to assess the profitability of a specific firm, you could assess it from different perspective. You could assess it based on gross profit margin, or the operating profit margin, or net profit margin, or return on asset, or return on equity. Another type on the final section of subsection of the financial ratios, it's called market ratio. Market ratio is very, very important ratio to reflect the marketability of your assets. How is the market reputation and the soundness of this asset in the financial market? And this is why if you are interested to assess the marketability of your asset, you must calculate what we call market ratio. One of the very important market ratio, it's called earning per share, EPS. And I think I explained it at the first slide of this lecture. Earning per share, EPS, it's equal to earnings available for common stockholders divided by number of shares of common stock outstanding. In our example, EPS is equal to net income, or earnings available for common stockholders, divided by number of shares outstanding, and in this case it's equal to 2.9. Also, another important market ratio, it's called price earning ratio. Price earning ratio, PE ratio, it's equal to market price, divided by EPS that you previously calculated. But first, you calculate the earning per share, EPS, and then using it in the price earning to determine how is the price earning ratio in our case. And this also one of the very important ratio in assessing the marketability of your stock. Also, sometimes you are calculating market to book ratio. Market to book ratio. Market to book ratio, this is the market price per share divided by the book value of this share. Therefore, market price, if this share is trading in the market, it's easy to get its market price, and you divide it by the book value per share. How could we determine the book value per share? It's very easy. Book value per share, it's equal to the equity divided by number of shares outstanding. Equity divided by number of shares outstanding, this will give you the book value per share. Market price, what is the price of the share of the market? By dividing market price per share to a book value per share, you are determining a relation between market to book ratio. Here in our example, first we determine the book value per share, taking a equity, and we divided it by a number of shares outstanding, determining its book value, and then giving a look at the market price, dividing the market price by the book value, we determine the market to book ratio. As you see, if you have a firm, and as I advised you, if you would like to have a good knowledge about the financial performance of a specific firm, it is better if you could make the analysis of this firm from different perspectives. And please don't only depend on one perspective, but to have a comprehensive evaluation, a comprehensive assessment of the financial performance of a specific firm. You must do this by analyzing the firm performance from different perspectives. As you see in this figure, we have different perspectives. We have liquidity ratio, we have activity ratio, we have debt ratio, we have profitability ratio, and we have marketability ratio. And as you see, when we calculating each one of them, I have different ways of analysis. Either I'm using cross-section analysis, or I'm using time series analysis. The use of a hybrid combination of analysis using a mix of cross-section analysis and time series analysis, this will give you a good hint about how is the performance of this firm. Let me give you just one example, and this will be the same for the others. For example, in the current ratio, we agree that current ratio could be a good assessment for the short-term liquidity of the firm. To determine how is the liquidity position of this firm over the short term, I either depend on time series analysis or I'm using cross-sectional analysis. For example, using time series analysis, I'm going to assess the current ratio over number of years. For example, here I'm assessing it in 2010, it is 2.04. Assessing it in 2011, it is 2.08. Assessing it in 2012, it is 1.97. Okay. Then, studying in this, we will see that there is a decreasing in the size of liquidity. But when I comparing it with the industry average at a specific point of time, we found that it is 2.05, and it is almost near from the industry average. In this case, we could say it's okay. Our assessment is okay. But if I would like to have more information about the liquidity position, it's better that we calculate the quick ratio. Sometimes we refer to it as acid test ratio. Be careful. And in some textbook in finance, they refer to the quick ratio as acid test ratio. Quick ratio or acid test ratio, in a very simple way, we are going to exclude inventory of the current assets. So as you see, current assets minus inventory divided by a current liability. As you see, when you compare the quick ratio to the current ratio, you will find that the quick ratio numbers are more accurate because we executed the inventory. But when we comparing it with the industry average, also it is okay because all of them, it's around our industry average. But this is okay. Giving a look over time series, we having positive trend, 1.32, 1.46, 1.51. According to a time series concept, it's good. So our overestimate for a liquidity position of this firm over the short term, we could refer to it as good, and so on. As you see, you are taking every dimension in your firm, and then you are getting a conclusion whether it is okay, whether it is good, whether it is bad, and so on. Please, what is required from you in this section is you must aware of the subsections that could be used in our analysis, and how could you conduct such analysis, and how could you interpret the meaning of it. The final part in our lecture, we have a special system. It's called the DuPont identity. DuPont identity. DuPont identity, it's used to investigate the meaning of the return on equity. We agree that return on equity can be used for assess the profitability of a specific firm. I would like to assess, if I decided to invest in the equity of this firm, how much I'm going to earn for such a type of investment. Using the shortcut of the return on equity, which is net income divided by a total equity, maybe this will not give you enough explanation about how is the situation of the return on equity in this firm. This is why a very famous scientist, he developed a system and our identity, and we refer to it by the DuPont identity. The DuPont identity, they are taking the shortcut of the return on equity and splitting it into three subsets. Had a shortcut of the return on equity and splitted it into three subsections. The first subsection, it is called operating efficiency. The second subsection, it is called asset use efficiency. And the third subsection, it is the financial leverage. By splitting the return on equity into its three subsections, operating efficiency, asset use efficiency, financial leverage, in this way, you will be able to determine what is the main reason why the return on EE is good or why the return on EE is bad, because you are aware of the main components of this ratio. As you see, according to the DuPont identity, we are taking the shortcut of the return on equity, net income divided by total equity. First, we split it into two parts. Return on equity, it's equal to net income divided by total assets multiplied by equity multiplier. Equity multiplier, it's equal to total assets divided by the equity. Then the ROA, return on asset, will be further split into two subsections. The first one is the net profit margin, which is net income divided by total operating revenue. This is the net profit margin. Asset utilization, it's equal to total operating revenue divided by the total assets. Total operating revenue divided by total assets. This is a two subsection. As you see, if we would like to reflect the return on E according to the DuPont identity, ROE is equal to profit margin multiplied by total asset turnover multiplied by equity multipliers. We will have the same result, which is the 14%. But the main difference between this long form of the ROE and the cut form of the ROE, in the first equation of ROE, net income divided by total equity, didn't tell us a lot how is the situation in this firm. But by splitting the return on equity into different subsections, splitting it into profit margin, net profit margin, splitting it into total asset turnover, splitting it into equity multiplier, then you are aware of how is the situation in this firm and what is the main responsible for increasing or decreasing the return on equity. This is one of the very important thing that you must aware, the DuPont identity and what is the main purpose of this identity. The last section in this lecture, we have a concept, it's called standardized financial statement. Standardization, because we found that in many cases, it is very difficult to compare between different balance sheet if they are in its real value, because especially if you are comparing big firm with a small firm. A comparison between big and a small firm, or a comparison between two different firms using its real value, it's not logic in some situations. Therefore, we are using this concept of standardization. Standardization, and we are aiming to convert our financial statement from its real values to be standardized financial statement. One of very common way is to convert our balance sheet from its normal form to be a standardized one. And if we converted it to be standardized one, we could refer to it by common size balance sheet. What is common size balance sheet? Yani this could be determined by taking each item in your balance sheet and you are getting it as a percentage of the total assets. When you are taking each item in the balance sheet and you converting it as a percentage of your total assets, this will be considered as a common size balance sheet. Another type is also we could do such a case using your income statement by determining common size income statement, and this will be constructed by taking each element existed in the income statement and taking a percentage of its total sales. In this case, you will have what we call common size income statement. But when we converted the normal balance sheet and the income statement into a common size balance sheet and the common size income statement, this process is called standardized financial statement. As you see, this is a normal case of a specific balance sheet. To convert it into common size balance sheet, we will take each element in this balance sheet and we divide it by total assets and determining it as a percentage. For example, in the cash is 84. This is the real value of this cash. If you would like to convert it into a standardization, we divide it by total assets. But in our case, we divide 84 divided by our total asset 3,373. We're getting it as a percentage, and this will be the form of your balance sheet after standardization in a shape of common size balance sheet. Of course, if you have your balance sheet in this form as a common size, it will be very easy to compare between the balance sheet over many years or comparing it between different size of firms, small firms and large firms. The same situation in the income statement. You could standardize your income statement by determining common size income standardized income statement or common size income statement. In this case, you take each element in your income statement and you divide it by total sale to determine it as a percentage. Yani for example, in the first one, sales divided by sales, it's 100%. Cost of goods sold, 1,344. Divided it by total sales, it will give us as a percentage and so on. As you see in this form, we converted our income statement to be in a shape of common size income statement, and in this way it will be more easier to be interpreted and compared with other type. By the end of this, I would like to thank you for your attention, and please, when you are reading this part, you must be aware of why we need to conduct financial analysis, cautions that must be considered when we analyzing our financial statements, basic important financial statements and the main difference between them, and then how could we conduct the financial analysis using financial ratios, using different subsections of financial ratios, and the main importance of each one of them. And finally, you must be aware of a standardized financial statement, of how could we edit the common size and of balance sheet and income statement in its standardized form. Thank you, and seeing you inshallah next lecture with my best wishes.